So when we say what is the objective of an investment, there are three broad objectives: capital preservation, capital appreciation, and current income. For capital preservation, the need is to minimize or avoid chances of capital erosion. So you don't want somebody to lose out on the capital. Typically, the target audience for this is highly risk-averse individuals, short-term investors, senior citizens, and so on and so forth. Also, people who have accumulated sufficient wealth, which they feel is sufficient enough for their entire lifespan, those also would go into capital preservation. The next category is capital appreciation, where people are either earning through salaries or through businesses or through professions. Here, the objective is to grow your portfolio over a period of time. So you want accumulation to happen, you want appreciation to happen. And these are typically the long-term investors. So most of the investors in the retail and the HNI category, lower HNI category, would be a part of capital appreciation. The ultra HNI category would probably be in the part of capital preservation. The next category is, the next objective is current income. So there are certain people who want to generate regular streams of income. So for them, it could be something like an SWP plan or something like a pension plan or an annuity plan. And they would ideally be retired individuals. So somebody who is retired will and wants a current income out of the existing whatever he or she has saved over a period of time, that would be current income. And if they are just preserving that capital, that would be a part of the first objective. Required rate of return. So let's say a person, an investor, postpones consumption worth 100 rupees today for a guaranteed future consumption of 102. Now what is happening here is he or she is doing a delayed gratification. I don't want to spend 100 rupees today because I want to spend 102 rupees going forward. Now here 2%, which is 102 divided by 100, is the pure rate of interest or the risk-free rate, real risk-free rate. Now investor demands this in absence of any inflation or uncertainty. So I'm not considering inflation, I'm not considering uncertainty. Even then, I would want this to be there. Okay, that this basic thing, I want it to be there incorporated. Now, obviously, in reality, inflation and uncertainty, which is risk, both exist. So what happens because of that? The real risk-free rate plus the inflation adjustment will be equal to the nominal risk-free rate. Okay, so I'm repeating, real risk-free rate, which is just a basic adjustment for postponement of gratification. That plus inflation adjustment is your nominal risk-free rate. And the real risk-free rate plus risk premium is your required rate of return. So this is how it gets calculated. We have an example in the next slide. Nominal risk-free rate, if you see, let's say somebody gives up 100 rupees today for 102 rupees going forward from 1 year now. And there is a price level increase, that is inflation, at 6%. How do you calculate nominal risk-free rate? It is 1 plus real rate of return plus multiplied by 1 plus expected rate of return minus 1. So the answer will be your 8.12. Now remember, these formulas are important because you may get some small quizzes, some small questions on this, and we need to remember the formula. Types of risk, so possibility that the actual earnings could be different from what is expected is actually the risk. So when we start off, we have earmarked that, okay, I want this to happen for me, but there could be a deviation from that. And if that deviation happens, the reason is the risk. So there are multiple types of risks which are there. First and foremost, you have the business risk. So if you have to talk about the business risk, uncertainty of income flows caused by one's nature of business. That could be one thing. Volatility in sales, volatility in operating profits, leverages would be another business level risk. Fluctuation of sales and earnings over a business cycle could lead to a separate risk, right? If I have to talk about financial risk, it relates to asset classes like equities and debts where my money is parked. When a firm borrows money, it requires to make fixed payments over a period of time. Now, this is definitely a financial risk. The increase in uncertainty because of use of fixed cost of financing is also referred to as the financial leverage. So that's also part of financial risk. Coming to liquidity, we understand what liquidity means. It's the ease of converting any money in an asset into cash format at the earliest possible. Okay. The more difficult this is, the more higher is the liquidity risk. So typically we talk about treasury bills having the highest liquidity, gold possibly having also very high liquidity, FDs, bank accounts having high liquidity. When we talk about low liquidity, we talk about products like real estate. We talk about products like art and sculptures, etc., etc. Exchange rate risk. It is uncertainty of returns introduced by acquiring investments denominated in currency different from that required for the investor. So let's say I am getting something in dollars or euros, and I want to convert it into INR. Then the dollar INR or the euro INR rates would indicate the exchange rate risk, that fluctuation also. Geopolitical risk. It is the influence of geography and politics on economics. So how does one country relate with another country? That is very, very critical for us to understand. And the relationship between different countries, the tensions between different countries, and so on and so forth. Then you have political risk, which is within a particular country. So if in India, the political situation is not stable, then that could relate to a political risk, because investors from abroad and otherwise also investors in India would consider that as a major dampening factor for the stock markets or the debt markets to perform. Regulatory risk. So what is regulatory risk? Basically, regulators like SEBI, AMFI, etc. Whatever they do and whatever regulations they come out with, that could also lead to certain parts of risks. Types of investments, so I don't have to get into the details. Everybody understands this. You understand what is equity, fixed income instruments, commodities, real estates, structured products, and other alternative investment opportunities. So let's look at what is distressed securities. So distressed securities, typically, if I have to talk about, these are companies who are on the verge of financial bankruptcy or financial distress, as we call it. These may be available at huge discounts, but we need to have higher skills to identify them. So what can happen is something which is offered at a 60% discount or a 70% discount as compared to its original prices may go down to zero also. So just because something is available, was at 100 rupees and now is available at 30 rupees, I don't need to take it. It can become zero as well. So I have to apply my financial acumen and apply all the knowledge and the skills which I've gained to actually understand whether this 30 rupees is going to go back to 100 rupees. If the answer is yes, then that's a good opportunity to buy a distressed security. If from 30 it's going to go to zero, then that's not the opportunity. Okay. These are also known as fallen angels, and that is where you can pick up them and create huge profits in your portfolios, but with a caution. Investment opportunities in the alternate section. So you have arts and paintings. There are rare collectibles. There are coins. Multiple part is there. Now, art does not have a standardized pricing. So you will have to identify the artist as well, and basis the number of creations with that artist has done, that also determines the price. Also, if the artist is going from a no fame to a fame zone, then that also will appreciate the price of his creations. Coming to the next thing. So from high to low, the rating scale is like this. So right from AAA plus, which is the highest rated on the CRISIL platform, to D, which is default again on the CRISIL platform. So this is the entire rate of rating scale which is there. Coming to the channels for distribution and investments. So basically you have the direct channel, and then you have the investments through managed portfolios. So in the direct channel, you have the RIA, and in the managed portfolios, you have the MFs, you have AIS, and you have PMS.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.